Some of the savviest real estate investors I know are quietly shifting part of their portfolio into hotels, and not for the reason you think.
Multifamily has long been the go-to investment for real estate investors looking for cash flow, tax advantages, and appreciation, and honestly, for good reason. But this is a different market. Higher debt costs, compressed multifamily yields, and more competitions means it's getting harder to find great deals that actually perform.
So today we want to introduce you to an asset class that's familiar, but also different enough to open up new doors. We're talking about hotels. And in hotels, you don't talk doors, you talk keys. And in this video, we're going to compare multifamily and hospitality side by side. So let's hop in, guys. Let's start with what they have in common. When we were at a hotel recently, I joked that a hotel and a multifamily are pretty much a big box that people pay you to stay in for a period of time, and they expect their needs met, and they expect a quality, safe place from a consumer standpoint. But beyond that, as an investor perspective, they both produce a bottom line, NOI. In hotels, they call it EBITDA, earnings before interest, taxes, depreciation, and amortization, guys. That's EBITDA. You hear about that a lot in evaluating businesses, and hotels are evaluated on that too. All that is the money you make minus the expenses that you had to pay before you pay your debt, before you pay your mortgage and all that kind of stuff, spits it out. In multifamily, we call it NOI. In hotels, it's called EBITDA, in businesses too. And they both are used to lever and to amplify returns, meaning if I can take an asset and make it produce more NOI or more EBITDA by increasing the revenue that it brings in the top line, or by saving money in the middle in expenses, either way, I'm making that property produce more money, and that makes it worth more because they're both evaluated based on cap rates.
Hotels and multifamily are very similar. We want people to stay in the property, and they're paying us, the owners of the hotel and multifamily apartment buildings, to stay in that property. Now, for hotels, we're charging people to stay by the night. For multifamily, we're charging people to stay for several months, often a year or more. So while the use cases of them are similar, the actual use of the property is very different. We have people that are staying for a very short period of time, and we have people that are staying for a long period of time. But ultimately, they're very, very similar investments, very, very similar business models, but the end customers are slightly different. Let's move on to section number 2, Matt, where we talk about pricing for multifamily versus hotels.
It's like dollars per chunk of time, right? And so for multifamily, it's dollars. That chunk of time is 1 month. And a hotel is typically a night or a week, whatever that may be. What I've loved about multifamily is the stability that multifamily gives you. The revenue is locked by the year. So I'm going to put a tenant under a year contract. They're going to pay me $1,000 per month for an entire year. That's very predictable, right? But it also means you're stuck if the market shifts. And I'll also say you are stuck if that tenant decides to break their contract and stop paying their $1,000 per month to you in some process, because rightfully so, there are plenty of laws to protect people's residents. If I'm staying in a hotel and I decide to not pay my fare that night, that hotel can certainly change the locks on my room.
Hotels, you can change the price every single day. And often, in fact, the best hotel operators can change price every day. And that gives the hotel operator a lot of flexibility. There are going to be certain times where people want to stay at your hotel more because of an event, because of seasonality. Typically, hotels do a lot better in the summer than they do in the winter, depending on the market. And sometimes major events like sporting events or festivals and things like that actually cause hotels to have much higher prices. We've all experienced this. You've stayed at a hotel and prices will be up 1 week versus another week. And that's because the demand is very flexible hotels. And because you're charging on a nightly basis, you as the operator can capitalize on that demand. And if there are not enough people staying at your property, you can lower the price dramatically day to day to get your occupancy up. So hotels, you have daily pricing adjustments, whereas in multifamily, you're likely not changing the price of your property or rent for more than once a year. Okay. And so that is a big, big difference between hotels. You have flexibility in the pricing. Rolling on to the next point here, because you have that flexibility in pricing, hotels might be arguably a better inflation hedge than multifamily might be, because you have that flexibility.
Well, flexibility is key. You need to be able to respond to changes in the environment with regards to inflation. So if cost of anything goes up, or if just the hotel across the street starts raising their rates, you can do that too. In a hotel, you can do that the next day. Whereas in a multifamily, you can't change on a dime like this. And this is where hotels really shine. And as expenses rise, you might be able to pass those expenses forward. You're not locked into long year rates. Your adjustable rates adjust every night to respond to ups and downs in the economy.
Hotels can be more nimble, right? They can tackle and track inflation in more real time. If inflation's out of control and you're locked into a bunch of one-year leases in multifamily, you can't necessarily respond that fast to inflation, whereas hotels you can, because you have real-time flexibility in the pricing. So again, hotels are a good inflation hedge because of your ability to change pricing on a regular basis. Now, Matt, it's not all sunshine and rainbows. Hotels are operationally more complex than multifamily. You have more cleaning staff, you have more people in and out the property. Talk a little bit more about the key thing to understand about hotels from an operational standpoint.
Me and the DeRosa team and Jacob too, we were all at a hotel just last week. And when we were there, obviously, there's people running around all over the place, people doing check-ins. The hotel we stayed in, of course, lovely, had free breakfast because a lot of people love having free breakfast at a hotel. The setup cost of getting all that going, they're very operationally intense. To everything from cleaning the rooms to checking in to setting up and maintaining the amenities the hotel has. And the brands that you might stay with, Hilton, Marriott, those brands have standards that need to get met. Multifamily doesn't have anywhere near the operational overhead that a hotel has. But if you look at the dollars per square foot that you make per month in a hotel versus a multifamily, it's quite a bit more in a hotel that covers a lot of those overhead and staffing expenses.
Yes, you do have the flexibility of changing the prices every day. Yes, you likely do have the opportunity to generate more revenue for that same size of box. But with that comes operational complexity. With that comes more payroll, more on-site staff, more cleaning, more marketing expenses maybe. And so all of that is a trade-off, right? Again, hotels and multifamily, one is not better than the other, but you have to understand the pros and cons of both. And definitely one of the cons I would say about hotels is it is more complex to run. But that's where you have to work with very skilled operators who are used to operating hotels. Just as you would work with a property manager for multifamily building, there will be a property manager who's used to running these hotels. And so that's just one thing to point out, though, is that hotels are more operationally complex. But to the next point, this is one big benefit of hotels that you typically do not have in the multifamily space, and that is brand. This is the hotels that we want to buy. These are the hotels that we're buying here at the DeRosa Group, and ones that we think you should be investing in or buying if you're an active operator as well. They're not boutique hotels.
In touring a lot of branded hotels and investigating that as an investment space, it makes me wish that there was branding in multifamily, because you see a lot more continuity of standards among branded hotels. You walk through one Hilton property, it's going to pretty much feel like the rest of the Hilton properties. It's going to feel a certain level of cleanliness. Even the sheets are going to feel a certain way. The room's going to feel like a certain level of vibe. The whole building has a certain level of vibe because the brands work very hard to maintain that through PIP programs and through just standards that they establish across their portfolio. You could walk through one multifamily asset that's a 50-unit apartment building, and right down the street, there could be a multifamily apartment building that's run by a different operator that's in the same market, charging the same rents, that could feel very different. They could have a very different expense budget, very different rental incomes and everything like that. What's great about the brands, they know how to make money. These are billion-dollar companies, and they take what they know in making money in the hotel space and they bring it in because they know what level of furniture works, they know what paint's going to work on the walls, all those things. And so they really set you up for success when you work with these brands.
And when you're partnered with the brand, they're also opening up their loyalty programs to you, right? So for Hilton, they have the Hilton Honors Program, which boasts over 200 million members globally. And those members like to rack up their points. They like to get free stays. And so they're going to book with Hilton properties. And so when you are a hotel operator or a hotel owner or a hotel investor of a Hilton property, you have the backing of Hilton and their loyalty program. And a bunch of leads, a bunch of people that are going to stay at your property are going to come directly from Hilton, which is a huge benefit. And it's not something that you can find on the multifamily side because there's not the same power of brand there. I just want to kind of double click into something you said very quickly, which is the PIP. PIP stands for Property Improvement Plan, and it is a brand mandated thing that Hilton's going to say, okay, cool. Every 5 years, we're going to need to refresh some of the furniture. We're going to need to repaint the buildings. We're going to need to update some of the bedding and things like that. This is all part of being a partner with one of these brands, because Hilton, like Matt said, wants every Hilton to look and feel very similar to Hiltons across the world. So in order
Hmm.
to ensure that level of quality, that level of standardization, they need to institute the property improvement plans, the PIPs. So while it is something that the investors are going to have to do and execute on, it is how they maintain the quality to make sure that their hotel stays in demand. So that is another benefit of the hotels, is going to have the backing of the brand, which you do not have in multifamily. So Matt, I think to kind of round out this video, what I'd love to do is to talk a little bit about a real world example. Two hotels that DeRosa is actually buying ourselves. So Matt, why don't we give the viewers a little bit of a quick rundown on DeRosa Capital 20?
20-year veteran of residential housing, buying single family homes and working my way up through apartment buildings into thousands of units of multifamily under control and under management at DeRosa. So I've learned through these projects and through investigations with DeRosa on the power of hotels, which is why I'm really excited that DeRosa is getting into hotels. That's where we've learned a lot of what we just told you. So we're acquiring 2 Hilton-branded hotels, one in Houston near a major airport and one in Milwaukee adjacent to a year-round event venue. They're both stabilized, cash flowing, and already outperforming their comps. Our strategy is to bring experienced management, execute some light cosmetic upgrades, and just optimize the pricing. Really, it's typical value add that you expect to see on multifamily, but it's done in the hotel world. We're bringing these properties up to the next level, up to the next standard of revenue, of quality, of all the things that you would expect to see in a Hilton branded asset.
Yeah, absolutely. And we visited these properties just last week, and we walked them, and they're beautiful. They're very different than, kind of like your 1960s value add multifamily deals. They're built in 2015, 2019. They're brand new, and there's very little wear and tear on the properties. And like Matt said, the big thing with these hotels is, one, the brands are very strong. The Home2 Suites and the Hampton Inn and Suites are 2 of Hilton's strongest brands. And also, another thing we didn't mention, Matt, is these are more your select service hotels. These are not luxury hotels. These are also not super cheap hotels. They're kind of middle market hotels, needs-based hotels, which do a lot better in the recessions. And so this is a little bit of a real world example of how DeRosa is investing in these hotels. We think these are great complements to multifamily investments, and there's good in both. There's pros and cons of both multifamily and hotels. Multifamily, a little bit more predictable, a little bit more stable. Housing is always going to be a core need. And so multifamily is always going to be a good investment. But hotels, a little bit more flexibility with the pricing, and a little bit more risk, but a little bit more upside and reward and higher revenue as well. And so you can kind of balance these investments and build and construct a very strong real estate portfolio if you have both hotels and if you have multifamily as well. We hope you found this video helpful today. DeRosa is very excited about hotels. We hope you're excited about hotels too. If you want to learn more about how you can invest in hotels passively, you can contact me or book a call with the DeRosa group. We can chat about DeRosa Capital 20 or future hotels deals that we're doing in the future. But that's it for our video today, Matt. We'll see you guys in the next video.